Back in 1847, there was this thing happening in Ireland that most people today have completely forgotten about, but it perfectly explains what happens to your money sitting in a bank account right now. During the Irish potato famine, families would hoard whatever resources they had, storing potatoes in root cellars, thinking they were being safe and responsible. Every single day, those potatoes were rotting from the inside out because of a fungus they couldn't see. The families felt secure because they could see their storage bins were full. But the actual value of what they owned was disintegrating at a rate of about 3 to 5% per week. By the time they realized what was happening, entire seasons worth of food had turned to mush. The families who survived weren't the ones who stored the most potatoes. They were the ones who immediately traded their potatoes for tools, livestock, or passage to America. They converted a rotting asset into something that could actually grow in value or generate future resources. Now, you might be thinking, this is just a history lesson about agriculture, but stay with me because what I'm about to show you is going to completely change how you think about that $10,000 sitting in your savings account. My name is Tom, and I spend way too much time thinking about how regular people get absolutely destroyed by doing what they're told is the safe, responsible thing with their money. If you're someone who has managed to save $10,000 or more and you're wondering why you still feel broke despite doing everything right, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that banks and financial institutions use to profit from your safety mindset, and more importantly, you'll know the specific moves to make today, not next month, not next year, but today, that will stop you from being on the losing side of this equation. I'm going to show you the mathematical reality that nobody talks about at dinner parties because it makes people uncomfortable, and then I'm going to walk you through what to actually do about it. This isn't about taking stupid risks or gambling your savings. This is about understanding that what you think is safe is actually the riskiest thing you can possibly do with your money right now. So let me take you back to that moment in history I mentioned, because understanding what happened in Ireland in the 1840s is critical to understanding what's happening to your money in 2025. Here's the thing. Ireland in the mid-1800s was almost entirely dependent on one crop. Potatoes made up somewhere between 30 and 60% of the Irish diet, especially for poor and working class families. The population had exploded from about 3 million people in 1750 to over 8 million by 1845, largely because potatoes were incredibly efficient. You could feed a family on a relatively small plot of land. People felt wealthy, in a sense, because they had abundance. Storage cellars were full, markets were active. Everything looked stable on the surface. Then, in September of 1845, a fungus called Phytophthora infestans arrived, probably on ships from North America. Within weeks, entire fields turned black. The potatoes looked fine when you harvested them, but within days of storage, they rotted into an inedible, slimy mess. Now, here's where it gets really interesting. The first year, people thought it was a fluke. They had some stored potatoes from previous years. They tightened their belts. They waited for the next season. The British government, which controlled Ireland at the time, brought in some relief measures, but insisted that the free market would correct itself. People were told to be patient, to hold on to what they had, to wait it out. But here's the catch. The fungus didn't go away. 1846 was even worse. 1847 was catastrophic. Families who had held on to rotting potatoes, hoping the situation would improve, found themselves with literally nothing. Meanwhile, Ireland was actually exporting food during this time. Grain, cattle, dairy products were being shipped to England while people starved. Why would they do this? Because the people who owned the land, the Anglo-Irish landlords, needed to pay their debts and maintain their cash flow. They couldn't eat potatoes. They needed pounds sterling. So they sold what was valuable on the market and left the Irish peasants with the potatoes, which were worthless. Over the next 7 years, 1 million people died. Another million emigrated, most to America. The population of Ireland dropped by 25%. But here's who didn't suffer. The landowners who immediately converted their resources into liquid assets. The merchants who traded in non-perishable goods The families who used whatever resources they had to buy passage to America where they could work for actual wages. And the banks and financial institutions in London that financed the whole system and collected interest, regardless of who lived or died. The people who got destroyed were the ones who thought they were being safe, the ones who held on to what they knew, the ones who waited for things to go back to normal. They watched their stored wealth rot away while telling themselves they were being responsible. Now you're asking yourself, what does a 19th century agricultural disaster have to do with my savings account? Everything. Your $10,000 in a savings account is rotting right now. Not as fast as those potatoes, but it's rotting. Let me show you the math, and I want you to really sit with this, because once you see it, you can't unsee it. Let's say you have $10,000 in a savings account at a major bank. If you're lucky, you're getting about 0.4% interest right now. Most people are getting less. Some of the big banks are paying 0.01% on regular savings accounts. But let's be generous and say you're getting 0.4%. That's $40 a year. Meanwhile, inflation over the past 3 years has averaged around 4 to 5% per year. And that's using the official numbers, which most people agree understate real inflation. But let's use 4% to be conservative. At 4% inflation, your $10,000 loses $400 of purchasing power every single year. You're earning $40 in interest and losing $400 in real value. That's a net loss of $360 per year, or a real return of negative 3.6%. Over 10 years, assuming inflation stays at 4%, your $10,000 will have the purchasing power of about $6,700 in today's money. You will have lost $3,300 or 33% of your wealth by doing the thing everyone told you was safe. But now you might think, okay, Tom, I understand inflation is a problem, but what's the alternative? If I invest it, I could lose money. At least in a savings account, I still have my $10,000. And this is exactly the psychological trap that keeps people poor. You're confusing the number in your account with actual wealth. Actual wealth is purchasing power. It's what that number can buy, and what it can buy is shrinking every single day. Here's another way to think about it. Imagine you put $10,000 in a savings account in 2010. You felt responsible. You had an emergency fund. You were doing what financial advisors told you to do. 15 years later, in 2025, you still have about $10,200 in that account after earning your pathetic interest. But let's look at what $10,000 could buy in 2010 versus what it can buy now. In 2010, the median home price in the United States was about $220,000. Your $10,000 represented about 4.5% of a median home. In 2025, the median home price is around $420,000. Your $10,200 now represents about 2.4% of a median home. You've lost more than half of your purchasing power relative to housing, which is most people's largest expense and largest asset. Or let's talk about the stock market. If you had put that $10,000 into an S&P 500 index fund in January of 2010, even with all the crashes and volatility, including the COVID crash in 2020, your investment would be worth approximately $43,000 today. That's not some theoretical number. That's the actual historical return. You would have more than quadrupled your money, while the person who kept it in savings effectively cut their purchasing power in half. The difference between those two choices over 15 years is about $33,000 in real wealth. That's a new car. That's a down payment on a house in many markets. That's a year of living expenses if you lose your job. That's real money that you gave up because you thought you were being safe. Now, this is where it gets really interesting. Banks know this. They absolutely know this. They're not stupid. They understand inflation. They understand purchasing power. So why are they paying you 0.4% interest when they know inflation is running at 4%? Why are they essentially charging you 3.6% per year to hold your money? Because they're making money on the spread, and they're making a lot of it. When you deposit $10,000 in a savings account, the bank doesn't just let it sit there. They're required to keep a fraction of it in reserve, usually around 10%. But with current Federal Reserve policy, the actual reserve requirement is close to zero for many categories of deposits. So let's say they keep $1,000 in reserve and lend out $9,000. They lend that $9,000 as a mortgage at 7% interest, or as a car loan at 6%, or as a credit card balance at 23%. Let's be conservative and say they're earning an average of 6% on the money they lend out. That's $540 per year they're earning on your deposit. They're paying you $40 and earning $540. That's a $500 profit per year on your $10,000, or a 50% return on the amount they actually had to keep in reserve. But it gets better for them. Because of fractional reserve banking, that $9,000 they lent out gets deposited in another bank, which then lends out 90% of that, which gets deposited somewhere else, and the cycle continues. Your original $10,000 deposit creates somewhere between $50,000 and $90,000 in total loans throughout the banking system, depending on the reserve ratio and velocity of money. The banking system as a whole is making interest on 5 to 9 times your original deposit while paying you almost nothing. This is not a conspiracy theory. This is literally how fractional reserve banking works. It's in every economics textbook, but nobody explains it in plain English, because if people really understood it, they'd be furious. And here's the kicker. When inflation is high, banks make even more money. Why? Because they're borrowing from you at 0.4% real return, which is actually negative 3.6% after inflation, and lending it out at 6% nominal return, which is about 2% real return after inflation. In an inflationary environment, the bank's debts to you, meaning your deposits, are being devalued by inflation, while the loans they made are being paid back in devalued dollars. They win on both ends. You lose on both ends. You're subsidizing their profits with your purchasing power. Now, you might be thinking, okay, this is depressing, but aren't banks regulated? Isn't my money safe because of FDIC insurance? And yes, your money is safe in the sense that if the bank fails, you'll get your $10,000 back. But safe from what? You're protected from the bank going bankrupt. You're not protected from inflation. You're not protected from losing purchasing power. You're not protected from staying poor. The FDIC insures the number in your account, not what that number can actually buy. It's like insuring those potatoes in the root cellar. Sure, you'll still have potatoes, but if they're all rotten, what's the point? This is the scam that nobody talks about. The entire financial system is built on the assumption that regular people will keep their money in low-interest savings accounts and checking accounts because they're scared. Scared of the stock market, scared of real estate, scared of risk, and that fear is incredibly profitable for banks. As of the end of 2024, there was about $18 trillion in U.S. bank deposits. If the average real return on those deposits is negative 3% after inflation and fees, that represents $540 billion per year in purchasing power being transferred from depositors to the financial system. That's more than the entire GDP of Sweden. Every single year, $500 billion is being siphoned out of the pockets of savers and into the profits of banks and the returns of people who actually invest their money. So what does this have to do with you and your $10,000? Everything. Because you're on one side of this equation or the other. Either you're the person losing 3.6% per year in purchasing power, or you're the person earning 6 to 10% per year in real returns. And the choice you make today determines which side you're on for the next decade. Let me give you an analogy that might make this even clearer. Imagine you own a car worth $15,000. You drive it to work every day, it's reliable, you feel good about it, but you also have a weird neighbor who offers you a deal. He says, I'll pay you $60 a year to park your car in my driveway instead of yours. You think, hey, that's free money for doing nothing. $60 is $60. So you agree. What you don't know is that every night, your neighbor is renting out your car on a car sharing app for $100 a night. he's making $36,000 a year using your car. He's paying for the insurance, about $1,200 a year. He's paying for gas and maintenance, maybe another $2,000 a year. And he's paying you $60 a year for the privilege of using your $15,000 asset. His net profit is about $32,000 per year. Your profit is $60. Oh, and by the way, every year, your car depreciates by about $2,000 because he's putting 30,000 miles on it instead of the 5,000 miles you would have driven. So your $60 gain is actually a $1,940 loss in real terms. This is exactly what happens when you leave money in a savings account. You're letting the bank use your asset for essentially free. They're making thousands of dollars in profit. You're earning pocket change. And the whole time, inflation is depreciating the real value of your asset. You think you're being smart and safe. They know you're being a sucker. Now here's where people usually get defensive. They say, but Tom, I need that money for emergencies. I can't just invest it and risk losing it. What if I lose my job? What if my car breaks down? What if there's a medical emergency? And look, I get it. I'm not telling you to be stupid. Emergency funds are important. But here's the thing. There's a difference between 3 months of expenses in cash and $10,000 rotting in a savings account for 10 years. There's a difference between liquidity and financial suicide. Let me break down what you should actually do. And this is going to be specific. If you have $10,000 saved right now, here's the exact allocation that makes sense for most people. Keep $1,000 to $2,000 in your regular savings account for immediate emergencies. Stuff that needs to be accessed in 24 to 48 hours. Your debit card gets stolen. You need to buy a last-minute plane ticket. Your water heater breaks. That's what this money is for. Yes, it's going to lose purchasing power to inflation, but it's a small enough amount that the convenience and peace of mind is worth it. Take another $3,000 to $4,000 and put it in a high-yield savings account or a money market fund. As of right now, you can find FDIC-insured high-yield savings accounts paying between 4.2 and 4.7% interest. That's actual nominal return that roughly matches inflation. You're not winning, but you're not losing. This money is for emergencies that might take a week or two to handle. You lose your job and need to float expenses while you find a new one. You have a medical bill that insurance doesn't cover. You need to help a family member. This is your true emergency fund, and it should be liquid enough to access within a few days, but earning enough interest that you're not getting destroyed by inflation. Now, here's where it gets interesting. Take the remaining $5,000 to $6,000 and invest it. Not gamble, not speculate, invest. And I'm going to tell you exactly how to do this in a way that minimizes risk while actually growing your wealth. Open a brokerage account with Fidelity, Vanguard, or Charles Schwab. These are the 3 major brokerages that have low fees and good reputations. It takes about 15 minutes to open an account online. You'll link your bank account, you'll transfer the money, and then you're going to buy a single fund. Not individual stocks, not crypto, not some complicated option strategy. One fund. You're going to buy a total stock market index fund or an S&P 500 index fund. At Vanguard, that's VTI or VOO. At Fidelity, it's FZROX or FNILX. At Schwab, it's SWTSX or SWPPX. These funds own hundreds or thousands of companies. When you buy one share, you own a tiny piece of Apple, Microsoft, Amazon, Google, Walmart, Coca-Cola, every major company in America. You're not betting on one company. You're betting on the entire American economy. And historically, over any 15-year period, the US stock market has never had a negative return, ever. Even if you bought at the peak right before the Great Depression, the dot-com crash, or the 2008 financial crisis, you would have made money if you held for 15 years. The average annual return of the S&P 500 over the past 50 years is about 10%. Some years it's up 30%, some years it's down 20%. But over time, it averages about 10%. Let's be conservative and say you earn 7% per year after inflation. If you invest $5,000 today and it grows at 7% per year for 10 years, you'll have about $9,835. If you invest $6,000, you'll have about $11,800. Compare that to the $5,000 in a savings account that will have the purchasing power of about $3,350 after 10 years. The difference is about $6,485 in real wealth. That's more than your original investment just sitting there working for you instead of working for the bank. But now you might think, what if the market crashes right after I invest? What if I put in $6,000 and it drops to $4,000 in a year? And yes, that can happen. It has happened. In 2008, the market dropped about 37%. In 2020, it dropped about 34% in a month before recovering. But here's what people don't understand. Those crashes are only losses if you sell. If you hold, if you wait, the market recovers. It always has. The people who lost money in 2008 were the ones who panicked and sold at the bottom. The people who held, or better yet, bought more when prices were low, made a fortune. Let me give you a specific example. Let's say you invested $6,000 in January of 2007, right before the financial crisis. By March of 2009, your investment would have been worth about $3,000. You would have been down 50%. Terrifying, right? But if you held by 2012, you'd be back to $6,000. By 2015, you'd have about $9,000. By 2020, right before COVID, you'd have about $18,000. By today, 2025, you'd have about $24,000. You would have quadrupled your money despite living through the worst financial crisis since the Great Depression. The only way you would have lost money is if you sold in panic at the bottom. This is the psychological shift that separates people who build wealth from people who stay broke. Wealthy people understand that volatility is the price you pay for long-term returns. They understand that a crash is not a loss unless you sell. Poor people see their account balance drop 20% and freak out. They sell at the bottom. They lock in their losses. They go back to their savings account where they feel safe, and they spend the next decade losing 3% per year to inflation while telling themselves they're being responsible. Here's another thing nobody tells you. The biggest risk to your financial future is not market crashes. It's inflation and inaction. Let me show you the math. If you leave $10,000 in a savings account for 30 years at 0.4% interest with 4% inflation, you'll have about $11,200 in nominal terms, but it will have the purchasing power of about $3,460 in today's money. You will have lost 65% of your wealth by doing nothing. If you invest that same $10,000 in an index fund, earning 7% real returns after inflation, you'll have about $76,123 in today's purchasing power. The difference between those two scenarios is $72,663. That's not a rounding error. That's a life-changing amount of money for most people. And this gets to the core of what I want you to understand. The financial system is designed to transfer wealth from people who are scared to people who are informed. Banks profit from your fear. Investment firms profit from your inaction. Inflation profits from your hesitation. Every day you wait is a day you're losing. Not in some abstract theoretical way, but in actual purchasing power that you could have used to buy a house, start a business, retire early, or just live a better life. So who benefits from you keeping your money in a savings account? Let's talk about the antagonist here, because there absolutely is one, and it's not some shadowy conspiracy. It's just how the system is designed. The primary beneficiary of your inaction is the banking system. We already talked about how banks make money on the spread between what they pay you and what they earn by lending your money out. But let's go deeper. Big banks like JP Chase, Bank of America, Wells Fargo, and Citibank hold trillions of dollars in deposits. As of 2024, JP Chase alone held about $2.4 trillion in deposits. If the average real return they're extracting from those deposits is 3% per year after paying interest, that's $72 billion per year in profit just from the spread. And that's just one bank. But here's what makes this really insidious. Banks actively market savings accounts as the responsible choice. They use language like security, safety, FDIC insured, peace of mind. They put pictures of happy families and smiling grandparents in their ads. They make you feel like you're being a good parent or a responsible adult by keeping your money with them. And on some level, it works because it taps into a deep psychological need for safety. We're wired to avoid loss more than we're wired to seek gain. Behavioral economists call this loss aversion. Studies show that the pain of losing $100 is about twice as intense as the pleasure of gaining $100. Banks exploit this. They make you focus on the fear of losing your principal in the stock market while ignoring the guaranteed loss of purchasing power in a savings account. And it's not just banks. The entire financial advice industry often steers regular people toward overly conservative strategies. How many times have you heard a financial advisor say, keep 6 months of expenses in a savings account, pay off all your debt before investing, don't put money in the stock market unless you won't need it for 10 years? All of this advice sounds reasonable, but it's designed to keep you poor. 6 months of expenses for someone making $50,000 a year is $25,000. If you keep $25,000 in a savings account, losing 3.6% per year, you're losing $900 per year in purchasing power over 10 years. That's $9,000 you just lit on fire because someone told you it was a safe thing to do. Here's the method they use to hide this from you. They talk about nominal returns instead of real returns. They show you a chart that says your savings account balance went from $10,000 to $10,200 over 5 years, and they call that growth. They don't show you a chart that adjusts for inflation and shows your purchasing power went from $10,000 to $8,500. They talk about FDIC insurance and make you think your money is protected when really only the number is protected, not the value. They use fear-based marketing about stock market crashes and show you charts of the worst possible scenarios without showing you the recovery that always follows. And here's the emotional reframe you need to make. You are not a victim in this system unless you choose to be. You have all the information you need to make better decisions. You have access to the same investment tools that billionaires use. You can open a brokerage account on your phone in 15 minutes. You can buy an index fund with 0 commissions. You can automate your investments so you don't even have to think about it. The only thing stopping you is a story you're telling yourself about risk and safety. Wealthy people don't think about money the way you've been taught to think about it. They don't see $10,000 in a savings account as safe. They see it as a wasting asset. They don't see market volatility as risk. They see it as opportunity. They don't see a 20% crash as a reason to sell. They see it as a 20% discount to buy more. This is not because they're smarter than you. It's because they understand the game. They know that the real risk is not temporary market fluctuations. The real risk is permanent loss of purchasing power through inflation and inaction. So let's talk about what you actually do today, right now, to stop being on the losing side of this equation. I already told you the basic allocation, 1 to 2,000 in regular savings for immediate access, 3 to 4,000 in a high yield savings account for emergencies, 5 to 6,000 invested in a total stock market index fund. But let's go deeper on the psychology and mechanics, because knowing what to do and actually doing it are two different things. First, you need to open a brokerage account if you don't already have one. I mentioned Fidelity, Vanguard, and Schwab. All 3 are good. I personally use Fidelity because the interface is clean and customer service is solid, but it honestly doesn't matter that much. Go to their website, click open an account, choose individual brokerage account, not a retirement account yet. We'll talk about 401ks and IRAs in a second. Fill out your basic information. It'll ask for your social security number, address, employment info, and bank account details for linking. This takes 10 to 15 minutes. They might ask you some questions about your investment experience and risk tolerance. Just answer honestly. It doesn't really affect anything. You're not going to be blocked from buying index funds because you said you're a beginner. Once your account is open, link your bank account. This usually takes 1 to 3 business days to verify. Then transfer the amount you want to invest. Let's say you're transferring $5,000. The transfer will take another 2 to 3 business days. Once the money is in your brokerage account, you're going to search for the index fund you want. If you're at Fidelity, search for FZ Rocks, which is the Fidelity Zero Total Market Index Fund. It has 0 expense ratio, meaning you pay nothing in fees. If you're at Vanguard, search for VTI. If you're at Schwab, search for SWTSX. Buy as many shares as your $5,000 will get you. That's it. You're done. You now own a piece of thousands of American companies, and your money is actually working for you instead of rotting in a bank account. But here's where most people screw this up. They invest $5,000. They watch the market for a week. They see their balance go from $5,000 to $4,850 because the market had a bad couple of days. And they panic. They think, oh no, I already lost $150. This was a mistake. I should sell and go back to my savings account. Do not do this. This is the exact moment where you have to override your emotional brain with your logical brain. Short-term fluctuations are completely normal and completely meaningless. What matters is where your account is in 10, 15, 20 years. Let me give you a concrete example of how this plays out. Let's say you invest $5,000 in January of 2025. Over the next year, here's what might happen. In February, the market drops 4% because of some Federal Reserve announcement. Your balance is now $4,800. In March, it recovers and goes up 6%. Your balance is now $5,088. In May, there's a geopolitical crisis and the market drops 7%. Your balance is now $4,732. You're now down 5.4% from your original investment. If you sell here, you lock in a $268 loss. But if you hold, by August, the market recovers and is up 12% for the year. Your balance is now $5,600. By December, it's up 18%. Your balance is now $5,900. You made $900 in 1 year, an 18% return, despite watching your account drop twice during the year. This is why the strategy is called buy and hold. You buy the index fund and you hold it through the ups and downs. You don't check your account every day. You don't panic when it drops. You don't get euphoric when it rises. You just let it sit there and compound. The eighth wonder of the world, as Einstein allegedly called it, is compound interest. When your investment earns returns, those returns start earning returns. Over time, this snowball effect becomes massive. Let's run the math on what compound returns actually look like. If you invest $5,000 today and add just $200 per month, which is less than most people spend on coffee and eating out, here's what happens at a 7% annual return. After 1 year, you'll have about $7,500. After 5 years, you'll have about $19,000. After 10 years, you'll have about $41,000. After 20 years, you'll have about $122,000. After 30 years, you'll have about $318,000. You invested $5,000 initially plus $200 per month for 30 years, which is a total of $77,000 of your own money. It grew to $318,000. That extra $241,000 is compound growth. That's your money making money. Now compare that to putting $77,000 in a savings account over 30 years. With 0.4% interest, you'd have about $81,000. Adjusted for 4% inflation, that $81,000 would have the purchasing power of about $25,000 in today's money. You would have lost $52,000 in purchasing power. The difference between investing and saving over 30 years is about $293,000 in real wealth. That's the difference between retiring at 65 and working until you die. But now let's talk about the other piece of this, which is tax-advantaged accounts. If you have access to a 401k through your employer, you need to be using it and you need to be maxing it out if at all possible. Here's why. When you contribute to a traditional 401k, you're contributing pre-tax dollars. If you make $60,000 per year and you contribute $6,000 to your 401k, your taxable income drops to $54,000. If you're in the 22% tax bracket, that saves you $1,320 in taxes. So your $6,000 contribution only costs you $4,680 in actual take-home pay. You just got a 28% instant return before your money even grows. On top of that, many employers offer a match. The most common match is 50% of your contribution up to 6% of your salary. If you make $60,000 and contribute 6%, that's $3,600. Your employer contributes half of that, which is $1,800. That's free money. If you're not contributing enough to get the full match, you're literally leaving money on the table. It's like your boss offering you a raise and you saying, no thanks. And here's the kicker. The money in your 401k grows tax-free until you withdraw it in retirement. If you contribute $3,600 per year from age 30 to age 65, that's 35 years of contributions, totaling $126,000. At 7% annual growth, that becomes about $496,000. If your employer matched $1,800 per year, that's another $63,000 in contributions, which grows to about $248,000. Your total 401k balance at retirement would be about $744,000. You contributed $126,000. Your employer contributed $63,000. The other $555,000 is compound growth and tax savings. Now, let's talk about Roth IRAs, because this is where it gets even better for some people. A Roth IRA is funded with after-tax dollars, meaning you don't get a tax deduction now, but all the growth and withdrawals in retirement are completely tax-free. If you're young, in a low tax bracket, or you expect to be in a higher tax bracket in retirement, a Roth IRA is incredibly powerful. You can contribute up to $7,000 per year as of 2025, or $8,000 if you're over 50. If you contribute $7,000 per year from age 30 to age 65 at 7% growth, you'll have about $913,000, and you'll never pay a dime of taxes on any of it. Compare that to a regular brokerage account where you'd pay capital gains taxes on your profits. If you made $500,000 in gains, you'd owe about $75,000 to $100,000 in taxes depending on your tax bracket. With a Roth IRA, you keep all of it. So here's the specific action plan. If you have $10,000 saved right now, do this today. Move $1,000 to $2,000 into a high-yield checking or savings account for immediate emergencies. Move $3,000 to $4,000 into a high-yield savings account or money market fund earning around 4 to 4.5%. Open a Roth IRA and contribute the maximum $7,000 for this year. Buy a total stock market index fund with that $7,000. If you have money left over after maxing the Roth IRA, open a regular brokerage account and invest the rest in the same index fund. Going forward, set up automatic monthly contributions. If you can afford $200 per month, split it between your Roth IRA and your brokerage account. If you have access to a 401k, contribute at least enough to get the full employer match, and ideally max it out at $23,000 per year if your income allows. Automate everything so you don't have to think about it. Set it up once and let it run for decades. Here's the thing that nobody tells you about building wealth. It's not about being smart. It's not about timing the market. It's not about picking the right stocks or finding some secret investment strategy. It's about understanding basic math, overcoming your fear, and being consistent over a long period of time. The difference between someone who retires with $2 million and someone who retires broke is not intelligence or luck. It's the decision to invest 10 or 20% of their income starting in their 30s instead of leaving it in a savings account or spending it on stuff that doesn't matter. I know this is hard to hear, but your $10,000 in a savings account is not making you secure. It's making you poor. Every month you wait is a month of compound growth you're giving up forever. If you invest $5,000 today and it grows at 7%, in 30 years, it'll be worth about $38,000. If you wait 5 years to invest that same $5,000, in 30 years, it'll only be worth about $27,000. You just lost $11,000 in future wealth by waiting 5 years. Time is the most valuable asset you have, and you can't get it back. So stop telling yourself you'll invest when you have more money saved. Stop telling yourself you'll invest when the market drops. Stop telling yourself you need to learn more before you start. You know enough right now to take action. Open the account. Transfer the money. Buy the index fund. Do it today. Not tomorrow, not next week, today. Because every day you wait, you're choosing to stay on the wrong side of the wealth transfer. You're choosing to let banks profit from your fear. You're choosing to let inflation eat your purchasing power. And in 10 years, you're going to look back and wish you had started today. This is not a get-rich-quick scheme. This is not gambling. This is the exact strategy that millions of people have used to build real generational wealth. It's boring. It's simple. It works. And the only thing standing between you and financial security is the decision to actually do it. So make the decision.